In studio with me today, we have John Loos, property economist at FNB. Always fun to chat about property data.
Hi, Michelle.
And really what we want to talk about is setting the scene for the residential rental monitor and the payment performance of tenants. But in order to tee that up, let's talk a little bit about the tenant survey, where tenants were indicating the severity of their loss of income during the lockdown period. 75% of our tenants indicating that they had a loss of income. 1 in 10 telling us that that income loss had been permanent, they haven't recovered. 1 in 2 tenants are telling us that they had a loss of income, a temporary loss of income, partially, but they've recovered. And 12% of tenants saying that they'd had a permanent loss of income, but for a temporary amount of time. That leaves us 25% of tenants, no loss of income. They should be able to meet their monthly expenses, their rental expenses as normal. So with that in mind, how did they pay?
Well, I suppose a portion of them didn't, Michelle, unfortunately. I think firstly, we have to look at the timing of the big loss of income. That would have been around about the second quarter. I suspect in the rental market, there's a very significant portion of tenants that have some sort of casual or, sort of less formal job, less permanent job. And so income is quite flexible and is affected quite severely and quite quickly when you have a sudden lockdown. I think of people who work in restaurants, for instance. Suddenly they just shut down and there is zero income. So I think that the rental tenant market probably got hit by that worse than the home owner market, where I think a bigger portion is sort of permanent employees with corporates and salaries for the time being go on through a sudden lockdown. So that's the first thing. I think since the second quarter, though, for many of the tenants, the income situation would have improved. We've eased the lockdowns dramatically. Restaurant business is not doing wonderfully, but it's open again. Tourism and hospitality is open again, although not doing wonderfully. So it's, there's a partial income there from a zero income previously. So I think things have been on the mend during the second half of last year. What you would probably see when you look at the TPN rental monitor numbers is that, so after a big dip in the percentage of tenants paying and in good standing, you would expect to see that improve later in the year and going into this year. But a lot of financial pressure would be hidden away in the vacancy rate, because new household, one of the tactics for when you get into financial trouble is not necessarily to stop paying or just to default on your rentals, but you also shut your household down. In other words, end your lease and move back with mom and dad into the family household. And for those who are with mom and dad, we don't move into the rental market. So you see a slower tenant flow coming into the rental market. In short, what you can see is that, and I think you probably did see last year, is that new household formation slows down, and the number of households, the growth in the number of households probably even turned negative last year. In other words, there's less households probably now. That's one way of countering financial pressure.
Absolutely. So the quarter-on-quarter growth that we saw in tenants in good standing was much slower in quarter 4 than it had been in quarter 3 coming out of quarter 2. If I remember correctly, we dropped right down to 73.5% of tenants in good standing at the bottom of the cycle. And as we've grown back up, we're now at 77.6.
Yeah.
So a much slower growth of tenants starting to recover at the moment. Do you think we're still going to recover into 2021? Where do you think we're going to go?
I think the recovery will be gradual. You see in a lot of economic data that post the lockdown, you saw a big rebound just because the economy opened up and was allowed to do business again. But thereafter, that the lagged impacts of that financial knock slows down the recovery thereafter. In a lot of economic data, you're seeing it, and I expect to see that same sort of trend in percentage of tenants in good standing. So if you go back to the first quarter of last year before the lockdown, it was 81.5% of tenants were in good standing. We're now at 77.6. We've improved from 73.5 at the bottom in the second quarter. I think I'd be surprised if in 2021 we reach 81.5 again. I think we'll gradually improve through this year, but we'll stay in the 70s, in the high 70s. It's a long road back just to get to that 81.5.
But let's give some context as well, because it's not all tenants that are stuck over at 77%. Some of the tenants are outperforming that, and that would be our sweet spot tenants, the tenants in the 7 to 12,000 rand, and even the 4.5 to 7,000 rand categories are trending above 80% in good standing. So these are tenants, I imagine, with formal employment that had less impact on those income shocks than our low end of the market, still only trending at 65% of tenants in good standing. Yeah,
unfortunately with big recessions, it's normally the lower income groups that take a bigger knock. They are less skilled, and they have less financial buffers a lot of the time. So the 7 to 12,000 rand, as you pointed out, the sweet spot, still above 80% of tenants in good standing. But then you go down to the lowest end, the below 3,000 a month rentals, that's around about 65%. That's in, I'd say, dire straits at the moment. And that is unfortunate. But I guess that's the teachings of these type of numbers that TPN publishes, is that a recession hits the poor harder. That's the unfortunate reality.
So if we look at our data now and you alluded to it just now, the vacancies sitting at 12.9% for Q4 as well, the highest we've had on record in terms of our surveys that we do with our estate agents. The high vacancies, absolutely, we're seeing a tenant market, supply and demand. There is more supply for property available than the demand, speaking again to your shrinking of the number of households as people move back with mum and dad, and that's impacted our escalations.
Yeah, so just to the vacancy rate, I mean, it's been a big rise through last year. Started the year at 7.5%, got to near 13% by the fourth quarter. Part of that would have possibly been not just financial pressure, but a portion of aspirant buyers heading into the home buying market due to the cut in interest rates late last year. So I think that possibly contributed to the high vacancy rate. But I think a portion of that rising vacancy rate trend is financial pressure, which either stops people from leaving their parents or delays their departure from their parents' home for longer. They just stay put, and also possibly takes a number back into their parents' home, or they go and share a communal digs, whatever the case may be, to cut down on the financial costs. So that's the and therefore a rising vacancy trend. And yes, then we go to the average rental decline, minus 0.75%. Now that's not a big drop yet, but for quite some quarters we've been seeing slowing growth in rentals, and now we've got to a national decline driven by deflation rates in Gauteng and the Western Cape, which are big rental markets. The other one's still mildly positive, but yeah, general slowdown, and I would expect through this year, with the vacancy rate we're talking about, for that average decline to accelerate for some time.
Yeah, I mean, our preliminary data show for Q1 that we are seeing that decline getting worse up until 2.5%. Negative escalation for Q1. But back to the prediction for 2021 for the property market. And I'm going to leave it open for you, both the sales market and the rental market. Residential, where do you see us going?
Well, I think the rental market's still weaker. In other words, rental deflation picking up downward speed through the course of this year, unfortunately. And that just comes purely from looking at that vacancy rate number, which is getting quite severe now. When it comes to the home buying market, I think that's got to taper off. The mortgage driven, the home buying surge that's been spoken about after lockdown last year, part of it was just due to transactions which couldn't happen during lockdown, but it is said that there was something extra. But I think that something extra was confined more to the mortgage-driven part of the market because of the big interest rate cuts last year. It was just an affordability of credit play. And you probably have seen the cash buying component decline quite substantially, because at the end of the day, that's more affected by the economy. There's no real strong economy to support this home buying surge that we saw. And so my conclusion is that relatively quickly, and in the next few months, I would say, that home buying and mortgage-driven home buying has to slow down, because all the economic numbers just point to a very serious knock last year, serious employment knock, serious income knock, and even if you look at FNB's estimated percentage of sellers selling to downscale due to financial pressure, that's up around 20%. That's a high number. So there is financial pressure in the home ownership market as well. Make no mistake. So no, I don't think that little good time that they've experienced can be sustained for the course of this year.
Well, there you have it, folks. Thanks very much to John Loos, FNB property economist, coming and talking to us about the residential rental monitor. Up next, John, you and I are going to talk a little bit about the commercial monitor, but we're going to do that in a separate episode. Thanks, everyone.